That's not a typo. $42 billion gone in 24 hours. This is the story of how tech billionaires killed a $200 billion bank. It didn't start with some complicated Wall Street scheme. It started with a tweet. Silicon Valley Bank was the bank for tech startups and venture capital. If you were a founder in Silicon Valley, your company's cash probably sat at SVB. During the pandemic, tech boomed. SVB's deposits nearly tripled in 2 years, from $60 billion to over $180 billion. With all that cash, SVB parked a huge chunk in long-term government bonds, normally one of the safest bets on earth. But bonds are only safe if you hold them to maturity. When interest rates go up, older low-interest bonds lose value. Nobody wants your old 1.5% bond when new ones pay 5%. SVB had bet on rates staying low. Then the Fed aggressively raised interest rates through 2022 to fight inflation. SVB's bond portfolio lost billions in value, on paper. At the same time, the tech boom cooled. Startups were burning cash, not raising new funding, and pulling money out to cover payroll instead of depositing more. To cover those withdrawals, SVB had to actually sell some bonds, turning paper losses into a real $1.8 billion loss. On March 8, 2023, they announced it and said they needed $2.25 billion in emergency funding. Here's the problem. SVB's customers weren't regular people. They were startup founders and VCs, all connected on Twitter and in the same group chat. Most had way more than the $250,000 FDIC insurance limit sitting in their accounts. Above that line, if the bank fails, your money isn't guaranteed. Prominent VCs started telling their portfolio companies to pull their money out immediately. In tweets and texts, the message spread in hours. Founders panicked and wired money out all at once. On March 9th, customers tried to withdraw $42 billion in a single day, about $1 million every second. That's a bank run. It's less about a bank actually being broke, and more about everyone believing it might be, and all trying to leave at once, which guarantees the collapse either way. By the morning of March 10th, under 48 hours after that first announcement, regulators shut SVB down, the second largest bank failure in US history. Thousands of startups suddenly couldn't make payroll. Panic spread to other banks. Signature Bank collapsed 2 days later. First Republic followed less than 2 months after, becoming the largest bank failure since 2008. To stop the spiral, the government took the rare step of guaranteeing all deposits at SVB, even above the normal insurance limit. SVB's CEO had sold $3.6 million in stock just weeks before the collapse. Regulators later admitted they saw warning signs and didn't act fast enough. But the scariest part isn't the bad bet. Banks make bad bets all the time. It's that a bank run that used to take weeks can now happen in hours, powered by a tweet instead of a line outside a branch. Follow for more of the biggest financial collapses in history. This one won't be the last.